Let me be brutally direct with you right now, because nobody else will be. Every single time gold hits a new all-time high, every single time oil spikes 20% in a month, my inbox and my comment section fill up with the same pathetic, desperate question from retail investors. Am I too late to buy? And I want you to hear me clearly when I say this. That question alone tells me everything I need to know about your financial intelligence. And what it tells me is not flattering. That is the question of someone who has already lost. That is the question of someone who watches prices on a screen and confuses price movement with investment logic. You are not analyzing, you are reacting. You are not investing, you are gambling with your retirement money, and the casino always wins when you play it that way. In the next 25 minutes, I'm going to rip apart everything you think you know about gold, oil, and commodities. Replace it with cold hard math and tell you exactly what to buy, how much to own, and what will financially destroy you if you get this wrong. Before we go any further, if you are watching this and you are not subscribed, you are making a financial mistake right now in real time. The information in this video would cost you $3,000 to $5,000 in a private wealth management consultation. I'm giving it to you for free. And all I am asking in return is that you hit the subscribe button and the notification bell. That is the single highest return on investment action you will take today. Do it now, before you forget, and then come back and pay attention, because what follows is going to make you significantly smarter about your money. Now let us talk about what I call the retail flow trap. And I want you to understand this pattern so deeply that it becomes burned into your brain as a permanent warning signal for the rest of your investing life. Here's what the data actually shows, and I'm not going to sugarcoat a single number. Look at GLD, that is the SPDR Gold Shares Fund, one of the most widely held commodity ETFs on the planet. That fund saw record inflows from 2024 into 2025, which was, and this is not a coincidence, precisely as gold was rallying 55%. Retail investors, people just like you, were pouring money in at the exact moment the asset had already made its biggest move. And then in March of 2026, GLD recorded the single largest monthly outflow in its entire 21-year history. Roughly $8.5 billion walked out the door in a single month. $8.5 billion of retail panic. $8.5 billion of people who bought high and sold in terror. That is not investing. That is the financial equivalent of running into a burning building because you saw other people running in before you. And before you tell yourself this was a one-time anomaly, let me give you two more examples that will make you deeply uncomfortable. Look at USO, United States Oil Fund. It took in record retail money in April of 2020. April of 2020. Do you know what happened to crude oil in April of 2020? It went to negative prices. Negative. People were paying someone to take oil off their hands, and retail investors chose that precise moment to pile in, convinced they were buying a generational dip. USO then went on to underperform the spot price, the actual price of oil you see in the news, by approximately 30% over the following month. 30% gone because they did not understand how the fund actually worked, which we will get to shortly, and because they were chasing a story, not analyzing a structure. Then look at uranium ETFs. These pulled in massive retail inflows through 2023 and into 2024, when spot uranium was trading above $100 a pound. The narrative was irresistible. Green energy, nuclear renaissance, the future of power, and retail investors absolutely stampeded in. The price then fell by roughly 40% by late 2024. 40% drawdown after massive inflow surge. The pattern is not subtle. It is not hidden. It repeats at every single cyclical top across every single commodity category. And yet retail investors keep falling for it like clockwork, decade after decade. The reason is simple, and it is psychological. Human beings are wired to interpret rising prices as validation. When gold goes up, your brain tells you it is going up because it is a good investment. What it is actually doing is telling you that the people who bought it 3 years ago are now selling to you. You are the exit liquidity. You are the last buyer before the collapse. And until you understand that viscerally, you will keep making the same catastrophically expensive mistake. So if chasing the spike is financial suicide, what is the legitimate, mathematically defensible reason to own commodities at all? Because there is one, but it is far more specific and far more limited than the gold bug community or the commodity newsletter salespeople will ever tell you. Let us start with the long-run performance data, because this is where most retail investors have been sold a fantasy. Over the period from 1973 to 2022, the Bloomberg The commodity index earned a quarterly Sharpe ratio of approximately 0.13. For those who do not know, the Sharpe ratio measures the return you get per unit of risk you take. Higher is better. The Sharpe ratio of 0.13 means commodities gave you very little return for the amount of volatility you had to stomach. Over that same period, stocks earned a Sharpe ratio of 0.21 and bonds earned 0.18. So right out of the gate, commodities were already the worst performer on a risk-adjusted basis among the three major asset classes. But that headline number actually flatters commodities because it includes decades of data that were relatively favorable to them. When you zoom in on the period after 2005, the picture becomes genuinely ugly. The Bloomberg Commodity Index, known as BQEQ, posted a Sharpe ratio that was essentially zero after 2005. Zero. That means you took on the full volatility and the psychological punishment of owning a highly cyclical, unpredictable asset class, and you received nothing in compensation for that risk. But it gets worse, because the reason most people put commodities into their portfolio at all is for diversification. The theory is that commodities move differently from stocks. So when your equity portfolio is bleeding, your commodities holding cushions the blow. And that theory used to be true. Before 2005, BCOM had a correlation with stocks of minus 0.3, meaning it genuinely moved in the opposite direction during equity stress. That is a real, legitimate diversification benefit, but after 2005, that correlation flipped to positive 0.49. Positive. Which means that in the very environment where you need your diversifier to save you, commodities are now more likely to fall alongside your stocks than to protect you. The diversification benefit that once made the asset class intellectually defensible has largely evaporated. Now, I want to be precise here, because I am not making an emotional argument. I am making a mathematical one. So if you run an efficient frontier analysis, which is a mathematical optimization that tells you how much of each asset class to hold in order to maximize your risk-adjusted return, and you plug in the post-2005 BCOM data, the model assigns close to zero to commodities. Close to zero. The math, when given the actual historical data from the modern era, says do not bother. That is a serious indictment of the asset class, and you need to sit with that discomfort before we go any further. However, I am not going to be intellectually dishonest with you, because the efficient frontier analysis does not capture everything that matters, and practitioners who manage billions of dollars know this. There is one thing that commodities still do exceptionally well, and that one thing is hedging inflation surprises. The correlation between BCOM and unexpected inflation over the 2005 to 2022 period is 0.69. That is a high number. That is a real relationship. And the reason it exists is almost insultingly simple once you hear it. Commodities are often the source of the inflation shock in the first place. When oil prices spike, when food prices surge, when metals prices explode, those are the events that drive unexpected inflation readings. So of course, commodities are correlated with inflation. Surprises, they are frequently causing them. This means that holding commodities in your portfolio is like owning insurance against a specific category of economic catastrophe. And that insurance has genuine, documented value. This is why the smartest practitioners in the world do not abandon commodities entirely, even when the mathematics of modern portfolio theory suggests they should. AQR published a paper in 2024 on strategic asset allocation that showed commodity allocation clustering between 5 and 10% of a portfolio in constrained real-world scenarios. Ray Dalio's famous all-weather portfolio holds between 7 and 12% in broad commodities and another 7 to 12% in gold. These are not sentimental decisions. These are not decisions driven by gold bug mythology or oil price momentum. They are decisions driven by a recognition that certain tail risks, hyperinflation scenarios, commodity supercycles, regime changes in the global economy, are not adequately captured in historical backtests, and that a small, deliberate allocation to commodities buys you meaningful protection against those scenarios at a reasonable cost. The mathematics says 0, the practitioners say 5 to 10. The truth, as it usually does, lies in acknowledging what mathematics is missing. So accept that 5 to 10% is the defensible range, size your position accordingly, and do not deviate from that range based on what gold is doing this week or what some commentator on financial television is screaming about. Now we need to get into the most important structural question, which is, given that you are going to allocate 5 to 10% to commodities, what do you actually buy? Because this decision will determine whether you capture the genuine risk premium that commodities offer, or whether you throw your money away on speculation dressed up as investing. And the answer here is stark and binary. You either own a broad commodity basket, or you own gold as a specific structural position. Everything else, single commodity funds in uranium, oil, copper, agricultural products, that is not strategic allocation. That is speculation. I do not care how compelling the narrative is. I do not care how many YouTube videos you have watched about the copper supercycle or the uranium renaissance. Single commodity bets are speculation. And speculation is a game that retail investors consistently lose. Here is why broad beats single, and I want you to understand this at a mechanical level. A paper by Erb and Harvey showed that the average correlation between individual commodities is approximately minus 0.09. That means individual commodities are essentially uncorrelated with each other. Pork bellies do not move in sync with gold. Oil does not move in sync with wheat. Copper does not move in sync with natural gas. And that low correlation structure, which sounds like a technical footnote, is actually the engine that generates returns in a broad commodity basket. When you hold a diversified basket of uncorrelated assets and you rebalance them systematically, you earn a premium purely from the act of rebalancing itself. This is called the rebalancing return or the diversification return, and in an equal-weighted rebalanced commodity portfolio, it amounts to roughly 3% per year above the weighted average return of the individual constituents. 3% per year, generated not by picking the right commodity, but simply by owning all of them and rebalancing. That is the only free lunch in commodity investing, and the only way to access it is to own a broad basket. The moment you concentrate into a single commodity, you forfeit that premium entirely and you take on enormous idiosyncratic risk in exchange for nothing. Gold is structurally different and needs to be understood separately. A paper by Bauer and Lucy found that gold functions as a safe haven during extreme stock market stress, but only for approximately 15 trading days. After those 15 days, gold investors typically begin losing money. Erb and Harvey's Golden Dilemma paper found that gold hedges inflation only over horizons measured in centuries, not over the 10 to 20-year horizons that are relevant for actual human beings saving for retirement. So what is gold actually useful for? It is short-term insurance against acute stock market crisis. Nothing more and nothing less. It is not a long-term inflation hedge. It is not a store of value over human investment horizons. It is a 15-day shock absorber for the worst moments in equity markets. That is a real and valuable function, which is why practitioners include it, but it must be sized and understood correctly, not mythologized. Now let us talk about fund mechanics, because this is where retail investors who actually understand the allocation case still manage to destroy their returns. The most important concept you need to understand is roll drag, and it is best illustrated by looking at USO, the U.S. oil fund, against the actual WTI spot price of oil. These two lines, over time, diverge dramatically. If you had tracked the spot price of oil over a given period, you would have earned a certain return. If you had owned USO over that same period, you would have earned significantly less, sometimes 30% less or more, and the gap is entirely explained by roll drag. Commodity ETFs that use futures cannot simply hold futures forever. They have to continuously sell the expiring contract and buy the next one forward. And because futures curves are usually upward sloping, meaning the future price is higher than the current price, you are perpetually selling low and buying high just to maintain your exposure. That continuous cost compounds against you. Every single month, you hold the fund, and over years, it can consume an enormous portion of your potential return. This is why how a fund manages its roll methodology matters almost as much as which commodities it holds. Funds like PwC use what is called an optimum yield roll methodology, which systematically selects the futures contract that minimizes this roll cost. That is not a marketing gimmick. That is a structurally superior approach that directly improves your net return. For gold, this question is entirely irrelevant because legitimate gold ETFs, gold etc. as they are known, hold physical bullion in allocated vaults. There are no futures, no roll, no drag. They buy the metal and store it, and your return tracks the gold price minus a very small storage and management fee. For investors in the UK and Europe, broad commodity funds under UCITS regulations typically use synthetic replication through swap agreements with banks rather than holding futures directly. Because UCITS diversification rules make direct, concentrated futures positions legally difficult, this introduces a small degree of counterparty risk, but it is well managed. Two collateral baskets are maintained at 100 to 120% of the exposure value, topped up daily. It is not a reason to avoid these funds. It is simply something you need to understand about what you own. Let us get to the specific funds. because knowing the theory is worthless if you do not know what to actually buy and how much it is going to cost you. In the UK, for broad commodity exposure, the cheapest fund currently available is the L&G All Commodities Fund at a fee of just 0.15% per year. There are 3 providers tied at 0.19%, all of which track the Bloomberg Commodity Index. And that is a defensible, well-constructed benchmark with genuine breadth across energy, metals, and agricultural commodities. UBS CMCI charges 0.34% and offers a roll-optimized alternative that reduces the roll drag we discussed. Every single one of these funds is UCITS compliant, and every single one is eligible for your ISA and your SIP, which is critically important because holding commodities inside a tax wrapper means that any gains you make on rebalancing, and over a long period those gains will be real, are completely sheltered from capital gains tax. That is not a minor consideration. That is a structural advantage that should push every UK investor toward prioritizing their ISA and SIP allocation before touching a taxable account. For gold in the UK, there are 4 providers: Amundi, Invesco, iShares, and WisdomTree, all charging 0.12% per year. WisdomTree also offers a sterling hedge version at the same fee, which removes your currency exposure to the dollar if that is relevant to your situation. For physical silver in the UK, Invesco charges 0.19% and iShares charges 0.20%. For us investors, the tax situation is more complicated and potentially catastrophic if you get it wrong. So pay close attention. Some U.S. commodity ETFs, DBC and GSG being the most common examples, are structured as partnerships. That means they issue K-1 tax forms at the end of the year. And if you hold these inside an IRA and the unrelated business taxable income, UBTI, exceeds $1,000, your IRA itself is required to file a Form 990T and pay federal tax on that income at trust and estate rates, which in 2026 can reach 37% at the federal level, plus several $100s in custodian and preparer fees for the filing itself. You went to the effort of building a tax-advantaged retirement account, and a partnership-structured commodity ETF can reach inside that account and take a chunk of it anyway. Avoid this entirely by using C Corp or 40 Act alternatives. PDC, which charges 0.59% and uses the optimum yield roll methodology, and BCI, which charges 0.26% and tracks the Bloomberg Commodity Index. Both of these issue standard 1099 forms and sidestep the K-1 and UBTI problem completely. For gold in the US, IAM charges just 0.09% and GLDM charges 0.10%. Both are grantor trusts. Both issue 1,099 seconds, and both track physical gold at roughly a quarter of the fee that the original GLD fund charges, which sits at 0.40%. For physical silver in the US, there is SIVR at 0.30% and SLV at 0.50%. The right choice among these options comes down to 3 variables: whether you are investing inside a tax wrapper ISA or SIP in the UK, IRA or 401 kilobits in the US, the currency you are investing in, and which roll methodology you prefer for your broad commodity exposure. If you are a UK investor in an ISA, the L&G fund at 0.15% is hard to beat. If you are a US investor in an IRA who wants to avoid the K-1 nightmare, PDBC or BCI and paired with IAEM for gold is a clean, defensible, tax-efficient solution. These are not the most exciting funds in the world. They are not going to make you feel like a financial genius at a dinner party, but they are the right answer, and the right answer is all that matters. I'm going to leave you with the hardest truth in this entire video, and it has nothing to do with fund mechanics or tax forms or Sharpe ratios. The hardest part of owning commodities in your portfolio is not building the allocation. It is not picking the right funds. It is not setting the right percentage. The hardest part is holding the position when it is absolutely destroying you, and it will destroy you at some point. Because commodities go through drawdowns of 20% or more, the kind of drawdown that happened in 2013 and again in 2023, and during those periods, every instinct in your body will tell you to sell. Every financial commentator you follow will be writing obituaries for the asset class, and the people who bought at the top of the last cycle, which is most retail investors, will be selling in panic directly to you, which is exactly the behavior we talked about at the beginning of this video. You cannot be those people, and you cannot let those people infect your thinking. Your rebalancing must be rules-based. Either you rebalance when the portfolio drifts beyond a defined threshold from your target weights, or you rebalance on a fixed calendar schedule. Annually is fine. Or you use a combination of both. But the rules must be set in advance and followed without exception, because the moment you start making judgment calls about whether now is a good time to rebalance into commodities, you have already lost, because your judgment in those moments will be corrupted by fear, and fear is the most expensive emotion in investing. So here's my command to you. Decide your allocation, 5 to 10%, split roughly half and half between broad commodities and gold. Pick the right funds from what I've shown you today, set your rebalancing rules, and then hold, not because it feels good, not because gold is making new highs, but because the math and the practitioners who have managed money through multiple economic regimes have told you this is the correct posture for a diversified, inflation-resilient portfolio. Now, go build it. Stop asking if you are too late. You are only too late if you keep making emotional decisions. The people who will be wealthy in 20 years are the ones who act on logic today. Be one of those people.